It's really interesting because for a very long time, we were zeroed in on capital expenditures, and that was the be-all and the end-all. There are stories on the Bloomberg terminal today about the credit profile and CDS, for example, on Oracle. Are investors starting to look deeper and at different data sets to assess the health of what's going on?
Yeah, absolutely. We look, though, at the structure of the national economy, and we look at CapEx as a share of GDP. What's interesting to note is that capital formation as a share of GDP is the same level as a percent as it was in 2018. So while we've seen a tremendous amount of investment, especially in the tech and AI space, from a national standpoint, it doesn't feel imbalanced. Now, rightly, investors are starting to wonder, what is the return going to be on all of the investment going into AI? We think that there has been a lot of excitement, perhaps over-exuberance in places. But clearly, as you mentioned, Ed, that there is a lot of demand still. And that's something that we think can continue to go.
You have a very clear line, which is the primary determinant in equity markets and equity prices is earnings.
100%, absolutely.
Well, we just had an astonishingly detailed earnings print from Oracle.
Yes.
What did you learn about the world from it?
Yeah, well, I think going back to what you just said, that demand for AI CapEx is still very, very high. When we think about what determines equity returns, whether you're looking at history since World War II or even the last year, for the S&P 500, 80 to 90% of the return comes from earnings. And so the outlook for prices is really predicated on, do you expect earnings to grow? And we do think so. We think earnings growth for the S&P 500 will be about 10% this year. That is largely predicated on an economy that we think will be growing above trend. We're expecting 2.4% real GDP growth versus trend growth for the U.S. of about 2%. That we think will generate that 10% earnings growth. We think, though, in our base case that the total return, though, for S&P 500 will be about 7%, which means not all of that earnings growth makes its way into the total return, primarily because we think multiples will come down a little bit from their currently elevated levels.
Interesting, because you've sort of been talking about the tech sector not being in a bubble, Matthew, talking about how valuations are relatively reasonable, and certainly Oracle's come down some in terms of its own PE ratios. But talk to us a little bit about the anxiety in the software part of the business. And Oracle
absolutely.
Spoke and pushed back against that. Have you pushed back against that more broadly?
Yeah, we do think that there should be some concern about the software sector. This, though, is reminding us of a few episodes historically, whether it was the global financial crisis and there were concerns about the U.S. financial sector and existential concerns. If we go back to COVID, there were concerns about the office real estate sector and whether it was dead. We don't think this time is different. Investors, unfortunately, tend to move en masse, especially when pessimism takes over. We think this time is no different. Reality is probably somewhere in between what we've seen in terms of the status quo and the existential concerns that investors have. We think of this more as an evolution of the sector. There's certainly a competitive risk, but we certainly don't think that this is an existential one where there's so much focus on the terminal value. We think these are absolutely very competitive companies that will continue to evolve over time.
There was a lot of anxiety in the market initially about software, and then look, there was the geopolitical risk that we're now combating day in, day out for a 12th straight day over with the Middle East and conflict with Iran. Matthew, does that change in any way your perspective on investing into this moment in where you are in the market?
Yeah, we're very focused on Iran, and it's terrible from a humanity standpoint. I think, though, we would focus, though, on from an investment standpoint that this resembles what typically happens when there's a geopolitical shock. Over the near term, there is a reaction by financial markets. What we've seen historically, and specifically, we've looked at the last 40 years, there are 21 airstrikes in terms of the U.S. in the Middle East, and we do see some patterns emerge. The first is that the initial reaction in markets is that risky assets like equities initially sell off, but then we see the dollar appreciate, we see oil rise, we see bond prices rise. But after about 8 weeks, fundamentals, whether economic or corporate fundamentals, reassert themselves, and the prior trend in financial markets resumes, such that after 8 weeks, 95% of the time, U.S. equities are actually above their pre-strike levels by an average of about 4%. So as a consequence, we haven't changed our views. We have a key investment tenet at Goldman Sachs that history is a useful guide. The words, "this time is different," we think are very dangerous. We think that history will repeat itself here and eventually markets will resume their upward trend.
We're every day trying to understand the long-term impact of AI on inflation and labor markets. And I know the Goldman House call is that AI may displace 1 million jobs a year.
Correct.
But there is also job creation happening in parallel. Just what you said about how one might approach that as an investor from your desk, in your perspective, what happens in the short, medium, and long term?
So we think technological innovation is a feature and not a bug of the U.S. equity market and the U.S. economy. The U.S. economy is by far the most innovative globally. It's a key reason that we recommend our clients be strategically overweight U.S. assets. Now, certainly AI is going to boost productivity, and unfortunately, it is going to displace workers. But as you mentioned, Ed, there's a tremendous amount of new job creation each year. Bear with me, some numbers here.
Sure.
There are 170 million jobs in the U.S. Each year, there are about 25 to 30 million jobs either lost or destroyed. But on the other side of that, and this is creative destruction, new jobs are created, and there are more new jobs created than jobs destroyed. So as we put that 1 million number into context, we think that a lot, if not all of those jobs lost to AI will be replaced by new jobs. Think about the investment we've seen so far, whether it's the construction of data centers, think about rising financial market prices, that's increased net worth, and it's increased consumer consumption. And so as we think about the net impact longer term, we're bullish, and we think that this is something that will be additive, even though over the short term there will be some tough adjustments.